Good afternoon, everybody. Welcome to this afternoon's session on personal financial management. I'm Gordon Angus, the Executive Director of the South African Engineers and Founders Association. I see that all of the participants' microphones are muted. I wonder if it wouldn't be better just to undo that. I'll work on that in a moment. Let me just do the introductions. So once again, welcome everybody to today's session. At SAEFA, we believe that financial literacy is one of the most valuable skills that one can develop in today's economic climate. But it remains, quite surprisingly, I think, underdeveloped, including in many workplace environments. We also understand that a financially secure workforce is key to any business's success, and poor financial management can have a disastrous effect on everything from employees' morale to productivity, overall well-being, and so on. So this is precisely why we've organized this session to try and provide everyone with the practical tools that one can use to transform one's approach to personal finances effectively. So the team from Masthead is back, Masthead Financial Planning, and they're going to be guiding you through three critical areas. Number one, building wiser spending habits to enhance your financial well-being. Two, understanding the mechanics of loans and credits, including those often overlooked details about interest rates and repayment terms and those sorts of things, which we all tend to want to shy away from. And three, making informed financial decisions around reducing personal debt and improving overall financial health. So guys, really looking forward to a very interesting session. And with that said, let me get off the mic and off screen. And Jamo, if I can hand over to you to take us through the session.
Thank you very much, Gordon, and thank you to the SAEFA team for this wonderful opportunity. It is really appreciated. And also a warm welcome to all SAEFA members for joining us today. So basically, over the next hour, we'll demystify the fundamentals that every informed individual should master. And welcome to the Money Matters once again. And it's my pleasure to be handing over to Ntsako, our professional financial planner, who will preside over today's main presentation and guide you through the essential financial principles. Thank you, and over to you, Ntsako. Thank you, everyone.
Thanks, Tiamo. Good afternoon, everyone. You are welcome. And I will just quickly share my screen and we just get into everything. Please let me know if you can see my slides.
Yes, we can see. Yes, we can see.
All right, thank you. Let me just make it a slideshow. Yeah. Okay, thank you. They have already done the welcome, and today we'll be focusing on the creation of a strategic roadmap to manage money wisely and achieve long-term financial goals and make financial decisions. I will not go, I'll say these topics already because Gordon has already mentioned the topics that we will be covering today. So I will begin with building wiser spending habits. Wise spending isn't about depriving yourself. It's about controlling your money so it doesn't control you. And we'll be covering the following topics, the following headings, just to elaborate on that. Wiser spending is the foundation of a long-term financial wellness. It's not about saying no to everything. It's about saying yes to what truly matters, whether you are trying to stretch your salary, save for a big goal, or break the cycle of impulsive buying. Wise spending starts with awareness and intentionality. So the first habit that one needs to have is to track every rand. You cannot manage what you don't measure. You need to understand your current habits before you can change them. For most people, money slips away unnoticed on small, frequent purchases. So it is very important to look at your bank statements every month and see exactly where your money is going. The second one is to create a budget based on real life, not on an idea or an ideal. A budget doesn't reflect your actual that doesn't reflect your actual lifestyle will always fail. So wise spending does not mean cutting out all enjoyment. It means you plan for it. An action step would be to break down your budget into categories. For instance, into needs, into wants, and also into goals. Sorry? Okay. So needs, we're looking at things such as rent, things such as food, transport, and electricity. Wants would be things like subscription, your Netflix, your dining out, and even clothes. And goals would be something like savings, investments, and emergency funds. The rule of thumb is to always use a 50, 30, and 20 rule, where 50% goes to your needs, 30% goes to your wants, and 20% goes to your savings and debt repayment. The third habit would be understanding emotional spending triggers. Many people don't spend from logic, they spend from emotion, because money at all times is an emotional thing. So boredom, stress, insecurity, or even celebration can trigger unnecessary spending. In this case, the action step to take would be next time you feel like a huge buy or a huge splurge, pause and ask yourself, am I bored? Am I stressed? Or am I even tired? Will this still feel necessary tomorrow? Is there a healthier way to feel better? And then instead, replace the urge to spend with a pause practice. Drink water, journal, walk, or delay the purchase by 24 hours. In most cases, if you actually delay it by 24 hours, you actually realize that because the following day you don't feel the same way, that you would actually be making an emotional decision based on your finances that would at the end of the day have a negative effect. The fourth habit would be use cash or card intentionally. Swiping a card or tapping a phone makes spending feel invisible, but physical cash has emotional weight. In some cases, but depending on the client and the client's lifestyle, we try and encourage the client to use cash envelope methods for groceries, for entertainment, or for eating out. And when the envelope is empty, you know that you are done for that month. Or alternatively, use different, if you have different bank accounts, use another bank account for money that you know will be for spending and for money that you know will be for needs. The third habit would be to set boundaries and stick to them. Without clear limits, even a small splurge can snowball into a very disastrous buy. For examples of smart boundaries would be limit eating out to possibly twice a month, depending on your lifestyle and your habits. Spending a specific amount a month on clothing unless necessary. Create a monthly allowance for fun or money, because use also your calendar or schedule spend weekends or low spend weekends for you to reset. The last habit would be to practice mindful spending. Wise spending is conscious and value driven. You buy based on priorities, not pressure. So mindful money questions to ask yourself would be, does this align with my long-term goals? Will I regret this decision tomorrow? Is there a better way to use this money? Final thoughts on building wiser spending habits would be every wise choice with 1 Rand leads to a future where 10,000 Rand choices are easier. Wiser spending habits do not just protect your bank account, they protect your peace of mind, they protect your goals, and they protect your future. So now I'm going to move on to the second topic, which is understanding how loans and credit works in South Africa. In South Africa, loans and credits are commonly used to fund personal goals, emergencies, education, homes, and even daily living expenses. But while they offer access and convenience, they also come with risks. The key is understanding how credit works, how it's priced, and how it affects your financial health. What is credit? Credit is when you borrow money from a lender, like a bank, credit provider, or a store, with the promise to repay it back, usually with interest and fees over an agreed period of time. There's different types of credit, and these include personal loans, vehicle finance, home loans, which are usually known as bonds, credit cards, retail store accounts, overdrafts, and revolving credits. So how does credit work in South Africa? When you apply for credit in South Africa, lenders consider the following. Number one, your credit score. Number two, they look at your income and your expenses. Your credit score is provided by the credit bureaus like your TransUnion, your Experian, your CompuScan, or XDX. And these range from 0 to 700 plus. There's someone speaking. From 0 to 599, you have poor credit. If you are between 600 and 645, you are average. If you are between 650 to 699, you are good. And if your credit score is on 700 and plus, then it's excellent. So if we look at an example where Tabiso has a score of 580 and he applies for a personal loan, let's say, for instance, at Capitec, because his score is poor, he gets approved, but at a higher interest rate of, for instance, 28%, compared to someone with a score of maybe 700, that person would actually get an interest rate of 14%. So those are also the type of things that you need to consider when you're then applying for credit. If your score is lower, then your interest rate will be far much higher. The lenders also look at your income and expenses. The lender must check if you can afford the loan under the National Credit Act. And this includes checking your debt to income ratio. So then they look at how much you're making and what are your expenses, where do you spend most of your money? And also they look at, when they look at your banking statements, they usually look where you spend your money. That's why it's not advisable to use most of your debit cards, especially on entertainment, because creditors also look at those things as well. So understanding the rates and the loan costs, every loan has interest rates. It's got initiation fees, it's got monthly admin fees, and most of them usually have credit life insurance. And if we can just look at the different types of credit and how they work, firstly, it's the personal loans. The personal loans are usually fixed repayment terms, for instance, 6 to 72 months. They're fixed or variable interest. These can also be used for emergencies, for weddings. Some people use them for weddings and for renovations. There's also credit cards, revolving credits. Some have interest-free period. Now, with most of the banks, the interest-free period will be up to 55 days. But if you take longer than 55 days to repay it back, then there will be interest on that. And the interest also can be charged if you only pay the minimum, which is not advisable. Store accounts has the most highest interest, between 20 to 25% most of the time, and they are easy to get approved for. Home loans usually have the lowest interest, prime plus minus margin, and these are long-term, usually 20 to 30 years. Vehicle finances, we also looking at a term of roughly from 12 to 72 months. There are those balloon options that some people like taking. These are low. This help you get lower monthly payments, but then we all know there's always that huge big lump sum at the end. The common pitfalls to avoid would be taking loans to cover over debt. So do not take a loan to cover another debt, because then the debt spirals. And remember, the loan that you will be taking to cover the debt that you have will also have interest on it. Missing payments, these hurts your credit score. Only paying the minimum, especially on credit cards. If you can, please do pay more. Borrowing for lifestyle or for status, not assets. So smart borrowing tips to consider would be to compare loans across 3 different institutions. In doing so, then you will be looking at the interest rates that are there. Okay, sorry, I see a hand, Charlene.
Hi, Ntako. I thought if I
Hi.
could just jump in and ask a question, please. There, I wanted to ask you, while we on the topic of loans and credit, what warning signs should someone look out for when they're applying for a loan or credit? I ask specifically because I know there are many employees that when they are in need of cash, then they will go to cash loans or loan sharks. And that, so if you could just give your opinion there, what should they look out for?
What warning signs in the event that maybe someone needs a loan? What would be the reason for the loan? Because I think that is always the most important thing. Hello.
Yes. I think I lost you there for a little while. Yes, but
Okay.
with the loan sharks and so on, and the cash loans, the small cash loans businesses and that, what should employees be wary of when approaching one of these institutions for a loan?
Okay, so the loan sharks, the interest rates are far much higher. That's the first one. They're far much higher. You'll find that most of them have 30% or even 50% interest that you need to pay. So you're paying far much more than you actually would with a proper institution like a bank, number one. Number two, another pitfall would be if and when you want to then make a big purchase at the bank, for instance, a house or a car, if there's a record of you using these small cash loans, it reflects badly on you as someone that can be borrowed money to, because it shows that your money management skills are not good, because you are unable to manage your monthly income, and there from time to time you actually get money from loan sharks to get these small nyana loans. I don't know if I've answered that correctly. Lincoln, I saw your hand up.
Yeah, I think I also just wanted to add this one thing though. The moment you apply for a loan at a bank or from a bank, and there's already you're already not getting an approval from them, that should already be a warning sign that your finances is not where it needs to be. So in terms, I understand, yes, yeah, people need money, that we are struggling, the economy is not where it needs to be. But the moment you apply for a loan and get declined at a bank, that should already be a warning sign to say that my finances is already at a place where it should not be at. And then if you move and you rather go to this other high risk funders or the loan sharks, that starts to then create a habit, because you'll find out how easy it is to get a loan with these guys instead of with the bank. So then it starts to create a different habit where the person become dependent on that outlet or that plan B to go to a loan shark or the high risk lenders that gives interest rates of about 40% to 50% on loans. So I would say the first warning signs or red flags should already be there. If I get declined from a bank, then it means that is why I need to pause and consult at least with someone that can help me with my finances, so we can understand, what would be the next step. In that instance, if you sit down with a financial planner or a financial advisor, they can look at your budget and they can look at why you need a loan, and we can try and figure out how we can offset certain things in your budget, or how we can create a healthy spending habit, or even how we can rework your budget so that at least when you do apply for a loan, worst case scenario, if you have to go through this high risk funders, that at least you've done it with a certain level of advice, instead of just going in there without no advice, knowing how that can impact you in the long run. Because in most cases, as I said, people would see how easy it is to get money from a loan shark, and then they start this never-ending cycle of every month going to that loan shark. So yeah, I hope that also adds some clarity on, or some, yeah, on that topic.
Yeah, I agree with you. And like I said, by the time you return back to the main lending institutions like your normal banks like Absa, Standard Bank, when they then go back and look at that record on your bank statements, then chances of you then getting, whether it's a house or a car or any big loan, then they become less. Okay. Charlene, is that okay?
Yes, thanks so much. I
All
see
right.
Melissa's got her hand up too.
Okay. Hey, Millie.
Good afternoon, everyone. Just to add on to what Lincoln and Nzako had said, a few other warnings would be not being required a credit check, meaning that you would go to a lender and then the lender would just start asking for banking details instead of doing a background check on whether you're employed and how much how much are you receiving monthly. Also, another thing would be that the lender would would want an upfront fee, meaning that they would want you to give them something in order for you to pay you that loan or to lend you that money. That is one of the other things. Another thing also could be aggression when it comes to sales. When an employee of that particular FSP or lending facility is pushing on making sure that you take the deal, not giving you ample time to to go back home and evaluate and rethink, as Ntako had said, take 24 hours and think about whether this is actually a need or a want. Those are one of the signs that are warning signs that I know of.
All right. Thanks, Millie, for that addition. Okay, so I will continue to smart borrowing tips. The first one obviously would be to compare loans across the three different institutions and obviously then look at the interest rates and see which one would be most suitable, which one would be the lowest, and look at the fine print as well. The second one would be to calculate the total repayable amount, not just looking at the monthly installment. Always read the contract and the fees, and this is something that a lot of people don't do. Always read the fine print. Don't borrow for consumptions like clothes or gadgets. Avoid loan sharks and unregistered lenders. We just spoke about that now. When to consider credit. So good credit would be buying a home, business capital, a study loan, a vehicle for work or income. Whereas bad debt would be borrowing for luxury holidays, store account and clothing splurges, gambling or fast money schemes, and loan to host a party or a wedding or lobola. Yes. So final thoughts on that. Understanding loans and credit is your shield against financial mistakes. In South Africa, where access to credit is easy but expensive, knowledge is always power. So borrow only with purpose, protect your credit profile at all costs, because it's very difficult to get it back and it might take time, and use debt to build, not break your financial future. Using credit well builds your financial profile and helps your future approvals and shows that you are a responsible money manager. So unmanaged credit leads to obviously blacklisting, stress, and even legal action. Credit is not the enemy, ignorance is. So learn the terms borrow before you borrow, and never borrow without a plan to repay. So now, I hope I'm not moving quickly. We'll be moving on to our last topic, which is making informed decisions to reduce personal debt. So debt isn't always bad, but uninformed financial decisions can turn manageable debt into a long-term burden. Whether it's clothing accounts, personal loans, credit cards, or vehicle finance, reducing debt requires both a strategy and a mindset change. This guide will walk you through practical and real life ways to understand debt and take control and build freedom. So the first thing would be to list your debt. Understand also the root of your debt. Before you create a repayment plan, understand why are you getting into debt? For example, was it because of an emergency? Is it because of a lifestyle? If it's a lifestyle thing, you probably need a financial coach to help through and over time instill new habits for you. Is it a lack of planning? And also understand how your current financial behavior keeps you into the debt cycle going. And as mentioned by Lincoln earlier, that then you realize that you start doing something probably maybe for an emergency, and after a while you realize that you're actually now in this cycle of debt. So when you list and categorize your debt, you need to make a complete debt inventory, including the name of your lender, the outstanding balance, the interest rates, the minimum monthly repayments, and the payment due date. The second one would be to choose a debt payoff strategy, a repayment strategy. So I'm only gonna name two today, and the first one would be the avalanche method, where you save more in the long run and focus on the highest interest first and then pay the minimum on the rest. For example, you pay off a loan that has, for instance, a 25% interest rates on it, and then focus on the other one that has like a 17% interest rate. The second method would be the snowball method. The snowball method, you pay off the smallest balance first for quick wins, which also helps you gain confidence and with your money management skills, and then roll over the payment. For example, if you settle your 300 Rand store card, that payment can go on to the next date, for instance. Or depending on your lifestyle, you can even use a hybrid of both these methods. You should also then consider consolidating or restructuring when it makes sense. So debt consolidation means combining multiple debts into one loan with a single payment, ideally at a lower interest rates. And there are companies out there that help with debt consolidation. But be cautious, only consolidate if the total interest is lower. And you won't use up freed up credit again, and avoid taking on new debt. Also, increase your debt repayment power. So you need to cut back temporarily on certain type of things like no eating out, shopping, or luxurious things. You need to possibly redirect bonuses, for instance, your 13th check or your tax refunds. Some people start a side hustle and offer services to get extra income in order to pay off debt. Some sell unused item, and some pause saving aggressively if debt has a high interest. Also, stop accumulating new debt. I think this is a non-negotiable. Pause your store accounts. Stop using your credit cards. Freeze them if need be. Don't take new loans unless it's for a true emergency or consolidation, and avoid this buy now, pay later options that are always offered by retailers. And always communicate with creditors. If you're struggling, don't disappear. Reach out and negotiate. Negotiate with them, ask for payment holidays, restructured terms, or interest rate reductions. Some lenders may often offer settlement discounts, and you can also use that if you can. Once you've settled your debt, it's always ideal to build an emergency buffer. So once high interest debt is cleared, make sure you have an emergency fund, and your emergency fund must always aim to be able to cover at least 1 to 3 months worth of expenses. Ideally 6 months, but in practice, most people don't have emergency funds that cover 6 months. But always make sure you've got an emergency fund that can at least cover up to 3 months of your monthly expenses, because at the end of the day, life happens to everybody. So no, that's the last slide. Real South African traps to avoid would be using a loan to settle another loan without even budgeting. Store cards with insurance and admin fees, because those underlying insurances actually make the store cards, your repayment, even higher. And most people, because we don't read the contract, these always just come built in within the contract. So taking out loan for others also is a caution. Please do not do that, because with experience, most people that you take out loans for don't end up paying, and at the end of the day, it's your name that gets bad credit at the end of the day. Loan sharks, I think we've covered that. And paying minimums, please avoid paying minimums only. If you can pay more, please do so, because if you only pay the minimum, you will be in debt forever. So the final checklist to consider is, in making these informed decisions before you borrow, would be, do I need this loan, or am I reacting emotionally? Do I need the total cost, including interest and fees? Can I still meet my other obligations if I add this debt? Is this purchase going to grow my net worth or reduce it? And have I explored alternative funding options? Final thoughts would be, debt is not a death sentence, but staying in it without a plan can cost you years of peace. Do take control, stay consistent, and remember, every payment, every small change is a brick in your financial wall. And lastly, do speak or consult a financial planner to advise and guide you through your financial decision making. And the reason for this is there is no blanket approach. So we as people have different lifestyles, we have different ways that we manage our funds, we have different priorities. So it's never, you cannot say just because there's a list of things to do, I'll just use everything. So do consult financial planner or someone that knows and understands how finances work, in order to have a roadmap towards your financial freedom. Thank you very, very much. I'll open the floor to questions.
Hi, Nsako, if I can start perhaps.
No problem.
How would you suggest, how can employees budget effectively if their income varies from month to month?
Just give me a second. Okay, so how can they budget effectively?
Yes, yes.
So the first thing would be to do is to get an average. So for instance, I work a lot with advocates, and they don't have a basic salary. So what we then look at is, always try to keep your expenses low, number one, and have an average of, over a 3 months or a 6 months period, plus minus. If once in a while you make 30,000, but you're ranging between 12 to 18,000, you know that your average is roughly 15,000. Your expenses should not be more than 12,000 rands, for instance, or if possible, less. This is just in an ideal world, but the first thing to do is then look at your average and see, okay, this is my average, and then make sure and try and spend as little as possible. I don't know, Lincoln, if you would want to add on to that.
Yeah, I think it's a bit of a it's a because we don't use a blanket approach. I think it's more of a personal thing, because someone would feel that, my budget or my expenses is 15,000 and I'm not willing to really go lower than that. So I think in that case, it's really a conversation of sitting down with a financial planner and really going through that in detail. So it's very difficult to just say, okay, this is how we can approach it, because of the individual that you're sitting with. That person has his own understanding of what budget needs to look like, what spending needs to look like. So I think it's a more personal approach that we would have to take, and that person would need to sit down with someone and really work out, how much are you willing to actually spend of your salary. Because in most cases, especially with this consumerism mindset, people believe like if I'm earning 30,000 rand a month, I can spend 30,000 rand a month. They feel that's enough. Then you get another individual that feels that 7,500 rand is enough, or 4,000 rand. So I think it's more of a situation where that person needs to sit down with a planner, a financial planner, and really understand. Obviously, the financial planner would understand the need and would try and work things out so that a person can understand how much needs to be put away or how much of their salary needs to be paid, to be spent on a monthly basis. I don't know if that makes sense, but it's a very difficult question to
It does.
answer, especially
It does.
because that person is working. I mean, I work for my money. I work hard. I wake up early in the morning. I work late at night. So it's a difficult conversation to have, but it starts with actually sitting down with that person and discussing and planning and working out budget on it.
But also when making your budget, you need to first look at what is your need, because people just spend on anything. So yeah, as difficult as it is, and it's like you said, it's not a blanket approach. I would say the first thing is know what is your average, number one. Number two, know what are your needs and what are your wants. Because sometimes we spend our money on wants, and now instead of focusing first on our needs. So always then just know that, okay, this is a need. Each and every month, this is what I need to cover. So yeah, I would say that. I don't know if there's a follow-up, Charlene, on that, if we've answered your question.
Just an add-on, sorry, Ntsako,
Okay,
just an
sorry, Millie.
add-on. As you had said earlier on, having an emergency fund or buffer fund also helps in this instance. Looking at the fact that this situation, the client would not be receiving the same salary every month. But if the client grows accustomed to putting a certain amount of money aside, bearing in mind that their salary is not the same monthly, then whenever a situation arises, they're able to go into the emergency fund before running to getting a loan.
Yeah.
Okay, thanks. Thanks so much. I think that's great advice.
Yeah.
And I also wanted to ask, can you recommend any apps or tools for managing day-to-day expenses? I know Ntsako, you did mention previously the envelopes, having different envelopes of cash for that to separate,
Yeah.
but is there anything else that you could suggest or any other options to manage employees' day-to-day expenses?
Yeah, well, it's not necessarily apps, but for instance, Old Mutual. Old Mutual has budgeting tools that are available that if a client needs one, that you can send one to them. It's like an Excel spreadsheet. It helps you and the client actually monitor their funds on a monthly basis. But that's for coaching things. But also most of the banking apps, I know Capitec also has a money in, money out option on it. So some of the banking apps now actually you can actually, if you can just explore your banking app even deeper, it actually helps with budgeting, and so that you know how much has gone in, how much has gone out on a monthly basis.
Okay, great. Thanks.
Yeah.
Is there
But
any
sorry.
questions? Sorry,
Yeah,
no, go
but
ahead.
sorry, but sorry, if there is someone that would actually want that, they should just let us know, and then we can check with the different service providers, because remember, we do represent different service providers, which would be then suitable for them, and then we will be able to then send that out to them and show them how to use it. But it's not usually an app, it's usually like an Excel spreadsheet type of thing.
Okay, great. Thank
Yeah.
you. And
Okay.
are there any questions
Link.
from any of the people online? I feel like I'm hogging the floor a little bit.
Their mics are muted. I don't know if we can unmute their mics.
Yes. Everyone can toggle their mics on and off.
Yeah.
If they would like to.
Okay.
Yeah. And
Link, you had something?
I do just have a question that I'm interested in. What financial advice would you give to someone in their 20s versus somebody in their 40s?
Okay. It depends on on which topic, because financial planning covers different things. There's risk planning, there's investment planning, yeah. So there's even estate planning, and yes, some people who marry early do need estate plans. So it depends on what type of advice. For instance, if it is investments, someone in their 20s still have a long time span. For instance, if we're looking at retirement, how they would invest towards their retirement relative to the next person in their 50s, even let's say maybe they want to retire at 65, would be different, because someone who's older, you wouldn't say don't go aggressive because you're really close to your retirement age, but someone who's younger would probably go a much longer. And also someone who's younger, if we're looking at risk, would probably need what's this, income protection, relative to someone who's older, who would probably need a life cover, whether for that life cover to cover their estate or even to cover the family that they have at that time, because you'd ideally think someone who's younger most probably has not settled down, for those that do not marry early, has not settled down, does not need estate planning, does not need life cover. So it's a really broad question. It would have to be, okay, that's why financial planning is actually tailored to the individual, because now you look at that person's situation, their family situation and their lifestyle and their income and their risk that they come across, and then you tailor make the advice for that individual. I don't know if I've answered. Okay, Link.
Yeah, I think from a perspective that a young person that started out working, always feel that they have enough time, that they have enough resources because they got their youth on their side. So most of the time, what I would do, when it comes to advice, I'll always advise him in terms of the things that I've made some mistakes on. Yes, I'm a financial planner, but when I was younger, I always also made mistakes. Mistakes such as getting too many clothing accounts, buying a vehicle that is a little bit beyond your means or beyond your budget, and just having an expensive lifestyle because you think that you are young and you're never really going to reach the age where you actually have to really respect your budget in that space. So the first advice I would give them is, seeing that you're young and you've got age on your side, let's rather plan the next stage of your life now. So the next stage of the life is probably they want to buy a house, or when they get married, they want to be settled. They want to have a good car. You can save towards a car. You can put the money away for a vehicle. You can put money away for a deposit on a house, and just make wiser financial decision. Because at a very young age, a lot of people would rather focus on splurging and having a lifestyle that shows off that I've got money, that I'm actually working, instead of really starting to put away money and building capital. So that by the time that they do get married and they do start a family and they do buy a house, they're actually in a better position than a lot of us that, were in. So my advice is always, yes, you are young, but don't really think about spending now. Rather put money away now so that when the important stuff in life starts to happen, where your health starts kicking in and you start having issues on that, at least there's capital that have been built. And then also in this age or in that space, I would then start to encourage the healthy financial behavior, like start putting away money now for a for a emergency fund, because now we're building a habit. So if you start building healthy habits from an early age, or from the time the person starts working, by the time he gets into 40, he is so used to already saving. He's so used to making sure there's an emergency fund, that he's got his investments, his RAs, and all of those stuff sorted. Then it's an easier conversation for a financial planner to have with him, to discuss then the next life cycle from there on in. So yeah, that's
And
normally my approach that I take.
Millie? And clothing accounts, please. I think those are the ones that, yeah, a lot of people get clothing accounts early. To please don't. Yeah. Millie, anything to add?
Yeah, I did. I wrote a little something for them on the chat box. They can
On
just
the
go
chat
through it.
box.
Yes.
All right. Is there any other question?
Thanks for that explanation. I've also, when someone's in their 20s, like Lincoln said, they seem to think you've got a lot of time and you're going to be working for a long time and you can save later and plan for your retirement at a later date. And then, but when they hit their 40s, they realize, it's coming closer, retirement age. It's not that far off. And then in the end, they end up having to either try and save more, or they will not be sufficiently covered by the time that they do retire and they are in their older age. Yes, which can be a problem. And no, please go ahead.
And also people who are younger tend to jump jobs a lot. Do not take your retirement if you've accumulated your retirement with your employer. That is because at the end, the calculation is aggregated over all the withdrawals that you've made over time. So yeah, people, when they move jobs, then they spend their retirement and start again, get a new job, spend their retirement. We've seen that a lot as well. Yeah, don't do that as well.
Thanks. And
great.
if you could
Thank you.
Sorry,
Charlene, are you finished?
Yes, please go ahead, Gareth.
No worries. So I had a question, and it's sort of one of those questions that comes up quite often, is if somebody has excess disposable income, would you recommend that they top up or cap their Provident Fund contributions, or would you advise them to then put that money instead into TFSA?
Link, do you want to take that or should I?
Okay, you can go ahead. And talk.
Okay, so in terms of the Provident Fund, it depends, because remember there's a cap in terms of deductibility. There's that 27.5%. So if it's more than that, if you've already reached your 27.5% annual that you're contributing, I wouldn't recommend for you to put it towards your Provident Fund. I would recommend the other option and not your Provident Fund.
100%. So let's say, for example, you have a 15% contribution to a Provident Fund and you have excess money. Would you then recommend, have you done the maths for whether to then top it up to as far or as close to 27.5% as you can get to? Or would you say rather take that money and put it into your TFSA?
Look, it also depends on the person in terms of how and when they want to retire and how old they are. So are you already contributing enough towards your retirement? If not, then let's top it up, because it's always advisable to have a plan and say, okay, I want to retire at this age and I want to have a certain amount of income that I get on a monthly basis. So if you have not reached that goal, I would recommend for you to then top it up. If not, and then the TFSA, why would you want to have, what would be the reason for that? Is it you just investing because you've got extra money also, or what? So that I would also then consider the reasons why you would want to take both options. But if you have not reached your retirement goal, I would always then say, let's put it towards your retirement.
Perfect. Thank you.
Yeah. Guys, do you want to add on that?
No, we're good.
Good. Okay. Next question. Yeah, because also consider, right, because that the tax free also is capped, right? There's a certain amount that you can contribute to on an annual basis. So like I said, if whatever reason you have for that, if it's an emergency fund, yeah, like I said, it's not a blanket approach. It depends on whether why you would want to have it as well. But yeah, because both have tax benefits, so it depends on your goal as well.
100%. I would also think that it depends on your liquidity goals as well. But I'm satisfied with your answer. Thank you.
Okay. All right. Thanks. Next question. Okay.
I think everybody's either too shy to ask questions, or probably more than likely they've obviously got the answers that they need. I think so.
I think Charlene had something to say again. It's okay.
Yes. Oh no, I just wanted to ask, what support can Masthead offer to members who want to provide further training to their employees?
What support can we provide? Look, if they want further training, they can let us know, and we can come in and train them. And they can also let us know in which topics and which field they would like us to cover for their employees, and we can come in and then have that session, communicate with them, make arrangements, and then come in and have that training sessions for their employees. I think that's a very good idea. Yeah.
If I could, team, maybe if I could put it to the members, if there are specific needs that you want addressed, or if there are queries coming through from your employees that they would like to get more advice or training, or sessions on training sessions and so on, just to send that through to us at SAEFA, and we can share it with the Masthead team, and then obviously they can then look at providing those solutions to those particular companies or groups of employees, or whatever the case may be. Yeah. All right, folks, thanks very much. I think very, very informative indeed. I think some exceptionally good tips there. I know just from experience that, and I don't do this as often as I can, but I'm always astonished that when I try and get back into that habit of tracking my spending and formulating budgets and that, for me, always the starting point has become just go and record as much as you can in as much detail as you can, what you're spending, because we all think we know what we're spending. Well, let me not talk for anybody else. I always think I know what I'm spending. But when I actually track it, for a decent amount of time, whether it's a few weeks or a few months, it's always quite surprising, and you realize, shucks, there's a lot I can actually be doing to improve my overall kind of financial position if I'm a little bit more mindful of what I'm spending on, and a little bit more mindful of how I'm spending and that type of thing. I think that's an excellent sort of starting point for people just to get going on that. And once you do that, then you can go into the more sort of detailed and intricate stuff, I guess.
Okay. Well, thank you so much for your time, and thank you for engaging with us. Yeah, this time there was more engagement. It was actually quite a fun session to have. Thank you for
absolutely.
that. Yeah.
100%.
Yeah, no, thank you so much, Gordon. And just to add on what you were saying, your member companies, please, they must feel free to reach out if they need us to maybe come and do an on-site visit, maybe to do a workshop for financial wellness for their employees. Please feel free. Yeah, thank you.
Yeah, absolutely. Desperately needed, I think. Obviously not everywhere, but at many companies out there, I think it would be a great idea just to have the guys get a few sessions on how to improve their financial position using the tips that you guys have shared today. Yeah. Brilliant.
Absolutely. Yes. Thank you.
All right. Perfect. Thanks very much then, everybody. In the absence of any further questions, sort of going once, going twice. Once again, thanks very much to the team from Masthead. Really looking forward to our next session. It's been a great afternoon, so thanks very much, and thanks everybody for participating and hopping on to the session this afternoon. Much appreciated.
Wait, Gordon, I think seeing
we've
something
got
in the
question.
chat. Yeah. Oh, okay. Is it advisable for someone who is just starting out in their career to consider things like life insurance, income protection, and disability cover? I'm curious about what level of financial protection is practical or necessary at the early stages of one's career. Should these be priorities from the beginning, or are they more relevant later on once you have more dependent assets or more established financial base? Okay. So I think it's similar to what Charlene had asked, that when you are in your 20s, where would you want, what financial advice would you give? So someone who's just starting their career and doesn't have a family does not necessarily need life cover unless they're buying a property for bond cover. So income protection would be, because your greatest asset is your ability to earn an income. So I would recommend that. Disability cover, yes, because someone who is younger, most probably reckless driving and fun, that happens. So disability cover is very much important. So it depends on a person's lifestyle as well. So when you're sitting with a client, you try and understand more about the person's lifestyles, their hobbies, their habits, and then you make recommendations as such. Things like retirement annuity, it's always best to get it early, and even compound interest will do the rest over time. And even if you start at the minimum, but it's always advisable to start early, and other things such as emergency savings or emergency buffers, as mentioned in this case. So it's never really a blanket approach, Hazel, but you actually then sit down with the client and try and understand what exactly is it that they need, and then tailor make the advice for them. But yes, there are certain products that are suitable for people who are younger than when someone is older. And do not just wait when you're older, because when you're older, then it becomes far much more expensive to catch up. I don't know if
Yeah, I think that yeah, I agree with Nsako. And again, from my side, it would just be that we're trying to also build healthy habits, or the habit of prioritizing these types of financial products that can assist you in future. So for someone that just started out in their career, it might not be necessary to have life cover for 2 million rand because they don't have a property as yet. But it is also important to have some sort of life cover. And hence, obviously, us designing a plan or some sort of protection for you that suits your need at that specific life cycle or stage in your life is important. I always tell clients it's very difficult to tell someone you need to pay a life insurance premiums of about 2,000 Rand at the age of 45 years old when you've never paid that in your life. So by starting off early, you create the habit of understanding the importance of these things. And I mean, that's the same principle I'm also trying to teach my kids, that from a young age, if you start saving and prioritizing certain things, you might not need it now, but the day it actually happens, you're already in that habit. For instance, having a life insurance premium or life insurance cover that you're paying every month, by the time you buy a house, we can just top up that cover and it will be suitable enough to, to be accepted by the financier. So you don't have to have those big type of covers, but at least start small. And that is obviously where a financial plan is going to take you through those steps. However, I also need to mention this one thing. So there's a difference between a financial planner and a sales consultant. So a sales consultant is going to get you at your age and give you the highest possible premium so that they can get the commission out of it. But a financial planner is going to sit down and say, okay, cool, because you're 20 something years old, you're still very young, you're still very healthy, so the premium you're going to be paying is also not as much. So let's start you off there and then obviously take you through different stages of your life, So yeah, that's my take on it.
And also remember that a life cover can be used for different things. So if you're young and you probably want to purchase a house, you would need life cover. So it can be used as in terms of bond cover, can be used as inheritance in terms of estate planning, and there's also young people that have received inheritances that actually have a lot of money that they use life covers in order to make sure that their trusts have money in the event that something goes away. So it's not really a blanket approach. We look at, do you actually need it, and what is the purpose of having, for instance, something like a life cover, and then we make the proper recommendations based on that. Yeah. Okay.
Perfect.
Yeah.
Thanks very much. Thanks, everyone. Just looking to see if there's any more hands. I don't see any hands, and I don't see any more questions in the chat. So again, excuse me, and as always, I think just to mention that if there are any questions that perhaps participants would prefer to raise offline, then of course you're welcome to do that. Send it through to us and we can pass it on to the team. Send it through to the team directly by all means. And obviously we'll get the guidance and the advice for you in that regard. Right. Perfect.
Absolutely.
Thanks very much, everybody.
Thank you.
Once
Thank
again,
you.
for all of
Bye-bye.
your participation. Thanks for the team, and yeah, have a good afternoon and a wonderful weekend.
Thanks very much. It was great.
Thank you
Thank
very
you.
much.
Bye.
Thanks, everyone.
Thank you. Bye.
Thanks all.
Bye-bye.
Bye-bye.
Thank you. Bye.
Okay, bye.